Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Parsarthi. Are you a holder of a debt instrument? It could either be a bond or an NCD, which you may have invested either through your wealth manager or through your financial advisor or through one of the bond platforms that provide electronic bond investment facility for you. If you are, this subject which we're going to talk about today is going to be extremely important for your investment. The topic that we are going to cover today is covenant breaches. What are they, and what should bond investors do if there is a covenant breach? Now, I will give the definitions of all these covenant breaches, etc., while going ahead. But if you are a bond investor or invested in a debenture or an NCD of an issuer that has issued the debenture, you may have received a mail from one of the trustees of the debenture of a covenant breach of a company and asking you to either waive off coming to a voting platform to either waive off the covenant or to exercise an option, whichever you may want to do, right? And you may, if you are not well versed with what a covenant is and what a covenant breach is and what it means to your investment, you may just ignore the mail, which may be detrimental to your investments. So listen to this podcast. It's going to be extremely important for your bond investment. And also, you must be aware that it could also mean the difference between good returns and also a weaker returns on your bonds, on the investments, bond investments or debenture investments that you have made, right? So the covenants are legally uh, binding contract between the issuer of the bond and the holder, debenture holder, or the bond holder, which is the investor, which is you, right? And there are many covenants that are listed at the time of issuance of the bond. And if there is anything that the company issuer breaches the covenant, then there is an action that is taken by the trustee of the debenture that needs to be addressed by the investor, right? And this is where we find that many investors do not actually exercise their options now, and which means that many companies are able to provide, many issuers are able to give covenants in their documents, debenture documents, and are able to, if they have breached it, they are not penalized for that. Now, there are many ways, I mean, many circumstances which may be external, which may not have, the company may not have envisaged, and where investors may want to exercise their option to waive off. But there are many circumstances where investors may want to exercise their option to exercise the penalty for the covenants, right? Where do you find these covenants? You will find these covenants in the information memorandum of every bond that is being issued. And the first thing you need to ask yourself or your financial advisor or the wealth manager or through the bond platform, whether they are providing you the information memorandum of the bond that you're investing in. Now, obviously, many of you may not have the time or you may not have the expertise to go through these IMs and see where the covenants are. So what we aim to do in this podcast is to give you a small idea of what all to look for in the covenants. And so next time when you receive a mail from the trustees, what you can then take a informed action on the breaches of the covenants, right? I have my young analyst from Capital Gate. Capital Gate Investment Advisor is a SEBI registered research analyst firm where they do a lot of work on credit research, and governance is one area that they cover very extensively. And Sambit will take you through what are covenants and what are the main covenants you might have to look for in an IM when you're investing in a bond. Sambit, can you just take our listeners through the main basics of all the covenants that they need to look out for, so that they can understand the breaches of these covenants and what it means exactly to their investments in the bonds and debentures.
Hi, thank you for having me on the podcast today. Now, covenants are legally binding provisions in the bond agreement. It is meant to protect the bondholders and also ensure that issuer maintains financial stability and operational discipline. Now, there are various types of covenants. Affirmative covenants that the issuer must take actions. Negative covenants, that is restrictions to protect financial health, and financial covenants that maintain specific financial ratios. Now, why are they important for investors? That they signal potential financial distress and they require close monitoring and proactive response to protect their investments. Right. Now, moving to the types of covenants, which are so there are two types of covenants, mostly investor friendly and issuer friendly. Among the investor friendly covenants, there is the step up covenant, which states that in the event of a rating downgrade, there might be an increase in the coupon for each notch downgrade. So investors have to be vigilant about the rating of the issuer. There will also be a covenant on promoter holding, showing the minimum holding percentage of the promoter. There might also be a security cover, which is the collateral for issue 1x or 1.2x of the issue. There might also be a prepayment penalty. That is, in case the issuer prepays the bond, the issuer has to pay a penalty over and above the coupon rate. There might also be a mandatory early redemption, which is on two notch rating downgrades, there will be mandatory early redemption of the issue. Coming to issuer friendly covenants, there will be the step down, which says in the event of a rating upgrade, a 0.5% decrease in the coupon for each notch upgrade. And there will also be a buyback. So option to buybacks from the secondary market prior to maturity. The option lies with the issuer. And then the call option is also there. That is the option to call back the bonds on specific call dates or coupon dates prior to maturity. Now, these are meant to be friendly towards the issuer, that is issuer biased. There are also the last type of covenants, that is financial covenants. Now, these might be lenient, these might be stringent. The more lenient it is, the more issuer friendly it is. So they can either cause a step up in the coupon or an early redemption once they are breached. And the metrics include leverage, capital adequacy, non-performing assets, and net worth, among others.
Thank you, Sambit. Now, let's ask the question of why do covenants get breached, right? Now, let's find out. Before that, let's go and find out why companies agree to certain covenants with the underwriters of the bond or with the arrangers of the bond, right? So the arrangers might go to the company and say, yes, I mean, if you give us all these investor-friendly covenants, which has very stringent financial conditions, etc., right? Step up coupons and prepayment clauses and many others. They might say that, because of these investor friendly covenants, that you might get a better pricing for the bonds, right? And it's also a type of protection, right, for the investor of the bond, which is fair for the investor, right? And the company may either if they do agree to all these covenants, very stringent and investor friendly covenants, then the company is forced to make sure that the operations of the company are fundamentally strong and that they do not breach any of these covenants, because the penalty is pretty severe, right? So this is where the trustee if you see in the recent 6 months to 8 months, because of the last one, there's been a 1 year period of deterioration in credit underwriting, largely due to economic circumstances, due to over lending, especially in the MFI sectors and MSME, SME, unsecured loans, many other factors, and general economic trends as well. That many of the lenders who have issued bonds to investors have breached covenants, now financial covenants, right? And some of them have got downgraded, so there's been a coupon step up and many other things, right? And so when some of the financial covenants have been breached, right, then and if the penalty is very severe, for example, if the financial covenants is breached, like a loan loss ratio, loan loss covenant, where loss covenant where the company makes a loss for an annual for one full year, right? And then if the company makes a loss for one full year, and then the penalty for that is a prepayment clause, then obviously investors may want to exercise that prepayment clause. However, in this what we the general trend that we find here is that investors do not exercise their rights on the penalties of the covenant, and that is largely because of ignorance, and also because of the fact that where they have invested from, whether it's their wealth manager or their financial advisor or the platform, do not tell them what to do on these covenants. So it's very important for investors in bonds to make sure that when they are investing in the bond or in the debt instrument, and whoever is suggesting that investment, they must be sure of the fact that when anything like these covenant breaches occur and they get mails from the trustees, they should be advised by these platforms on what are they, and the decision can be at the investor end, but at least they should know what they are, and they should get on to that whenever there is a voting. They should get on to that voting platform and then exercise their options, right? What we also find that most of the times when companies issuers call for waiver of covenants, they find that there is no quorum because investors just fail to turn up, and these are very important factors because it's affecting the investments made by you investors, right? So it's very important that investors should understand what are covenants, and there are many factors where you need not actually really exercise those options because it may be a genuine case where there could be some small deviation here and there, and it doesn't warrant a very strong action by the investor. But there could be some cases where there could be action taken by the investor where it does warrant action by the investors. So that decision is left to the investor. And obviously, if you have a good financial advisor, then obviously the financial advisor will let you know what is in your best interest. Investors should always protect their interests, especially. And when covenant breaches occur, it does mean that there are certain protections available for the investors to exercise their rights on the bond holding on the bond investments that they have made. Hence, it's extremely important that investors do understand what are covenants, what are the covenant breaches. Next time when you receive a mail from the trustee, go through that mail, send it to wherever you have invested from, ask them what they do, ask them what does this mean, what should you do, right? Or if you know yourself what to do, then you do exercise. Then the trustees on their end should do their job, especially when there is a covenant breach, sending out the notice for covenant breach and the action to be taken. And especially if the company is asking for a waiver of the covenants, the trustee should send the notice out in the right time. That is the job of the trustees. And if the trustees has not sent the mail, send the mail to investors, then investors should question what are trustees doing. And the job of the trustees is to make sure that investor rights are protected. So all that should happen seamlessly. So hence, especially this and covenant breaches typically tend to happen when there is a period of upcycle, where there is strong lending growth, there's strong traction in the economy, and sudden deceleration in the economy and the credit fundamentals of the economy as well. So if there is over lending, for example, and suddenly there's a downturn, then you can be sure that there are many of the lenders who have what is it called, diluted their credit underwriting standards could see covenant breaches, right? So like I said, some of them could be external to them, so they may not have it may have come at a complete it's not in their control, but a lot of it could be in the control because of they could have tightened, kept underwriting standards tight, made sure that they're not over leveraged, and many other factors as well. So all this is pretty much very important. So covenant breaches are definitely one of the main protection rights for investors when they're investing in bonds and debentures of issuers, non-convertible debentures. And it is very important that wherever they invest from, if there is a covenant breach, and if you get mails from trustees, you must know what to do. And and if you, obviously the first point of contact for you should be whoever told you to invest in the bond or where you invested the bond from. So that's going to be the most important factor for your investment in bonds. And this could mean that you could either make, if there is an early redemption facility for a company that is going through a loss, for example, then the bond, when an issuer goes through a loss, what happens is the bond prices tend to go down. So if you're able to redeem earlier, then it's good for you, right? But the idea is that if you don't go to the voting platform and vote for your rights, then you are not exercising that option, and it's actually proving to be detrimental to your investment in that bond. It may not lead to any kind of a default or any of that scenario, but the point is there is a certain action that you can take which can protect your interests, and they could take a call later against then to invest, right? So this is, like I said, this topic of covenant breaches, what are covenants and covenant breaches, are extremely important to bond investors. And you must now, when next time you receive a mail from your trustees, please do look at it very closely, go through it fully, and do exercise your voting rights. Thank you very much for listening in, and do follow us on all podcast channels.